we are maintaining the stable outlook on the reinsurance market, driven by several factors, primarily the positive pricing momentum that is expected to continue into 2021, improved terms and conditions, and also the focus on discipline by most players. This focus on discipline has been driven by some significant losses over the past 3 to 4 years, the diminishing favorable reserve development from prior years, the continued uncertainty from social inflation, and now, obviously, COVID-19. Also, the continued trapped capital to third-party investors and the ever-unrelenting low interest rate environment we've been experiencing is expected to continue. Companies are more focused on strong underwriting and profitability rather than, and also protecting their books of business rather than market share growth and just simply premium growth. There is also a flight to quality that we are seeing. Although not all the players will experience continued stable conditions and improved results, the ones that are expected to benefit the most are the ones with solid financial strength, strong reputation, and strong market positions. Good product diversification is also very important. Healthy balance sheets, of course, and consistent and transparent underwriting performance. On the life side, companies remain well capitalized and mainly concentrated in a few large global players. The main exposure obviously has been the spike in mortality caused by this pandemic. The life segment of global reinsurers have reported negative impacts on profitability due to the COVID-19, but these COVID-19 claims have come mostly from the U.S. players, since mortality coverage is really not that prevalent in other countries and in other older age group of people, which is basically, unfortunately, what's being impacted the most by COVID-19. So pricing in the reinsurance market has been hardening for a bit, but mainly in the US and Japan, and mostly for property risks, given all the events that we've had in the past 3 or 4 years. Other lines of business are also seeing some improvements, such as specialty and large commercial and casualty risks. We are also seeing some significant tightening in contract language, particularly due to social inflation, med mal issues, professional liability events, and obviously cyber. And now with the pandemic, we're seeing contract wording being rectified and changed a bit. Other important dynamics are that certain lines of business, like I've mentioned before, can no longer rely on prior year development. The interest rates continue to be low. Third-party capital remains trapped. And we also are seeing, unfortunately, frequency and severity going up for certain events like hurricanes and typhoons. And some companies are not able to meet their cost of capital. So we think that the pricing momentum that first started with primary and retro business, it's kind of spilling into the reinsurance segment, those middle layers, if you will. Those layers are still not adequately priced for the risk these companies are taking. So we think that the rate momentum should continue at these layers, at this layer level. How long this market dynamic is going to last, it's unclear. But at this point, AM Best believes that this pricing momentum will continue in order for companies to offset previous year losses, the COVID-19 pandemic, reserves that they put up for expecting losses from this pandemic, social inflation that continues, and then also social unrest and the low interest rate environments.